Welcome back to Investing Talk Podcast.
Today we're looking at BigBear.ai.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. What we have here is a company that's deeply entrenched in a sector with just massive barriers to entry.
We're talking about AI for U.S. defense and intelligence agencies.
Exactly. This isn't your typical commercial AI chatbot company. This is mission-critical stuff, national security, digital identity, advanced predictive analytics.
And that's really the core of it, isn't it? The stickiness.
The stickiness is everything.
It's all tied to these long-term government contracts that are, I imagine, incredibly hard to get and probably even harder to lose.
That's the foundation. Yeah. And because of that, we have to kind of look past the day-to-day market noise and really focus on their execution and their transformation.
Okay, so speaking of execution, the first thing that just jumps off the page is their balance sheet. I was looking at the Q3 2025 numbers. The cash position it's huge.
It's staggering. We're talking about a record cash balance of $456.6 million.
$456 million. So they have plenty of firepower to maneuver.
Oh, absolutely. That cash is the ballast for the whole ship. It gives them, really strong liquidity for growth, for acquisitions. It's basically a massive insurance policy.
Right, because contract timing can be lumpy in that sector.
Exactly.
No.
But, and this is a big but, liquidity doesn't always mean immediate success. And this is the contradiction that I think the market is really grappling with right now.
Okay. What's the contradiction?
Well, they're projecting full-year revenue for 2025 between $125 and $140 million, which sounds pretty solid.
Sounds great. So what's the problem?
The problem is the most recent quarter. Q3 2025 revenue was $33.1 million.
Okay. And how does that compare?
It's a 20% decrease from the same quarter last year.
A 20% drop. Wow.
Yeah, from $41.5 million in Q3 of 2024.
So how do you square that?
Yeah.
A big drop now, but a strong forecast for the full year. Is this a timing issue or something worse?
That is the core debate. And when you look at their TTM, their trailing 12 months net income, it makes it even more complicated.
Let me guess, it's not positive.
Not even close. It's a negative $443.9 million.
Whoa. Okay, so they are burning through a lot of cash.
A tremendous amount. But this is a transformation story. They aren't just, optimizing some old legacy system. They are investing heavily in new tech and M&A.
And that $456 million in cash is the runway that lets them do that? Without it, that kind of loss would be catastrophic.
Absolutely. They have the capital to finish the pivot. Now they just need to prove they can get the efficiency.
Which brings us to the big catalyst, right? They clearly needed a game changer.
They did. And that brings us directly to the acquisition of AskSage.
Yeah.
This is the centerpiece of the whole investment thesis.
This is where the growth story is supposed to kick in, moving past those less than great Q3 numbers. So what does AskSage actually do?
This is what expands their moat. AskSage is a high-growth generative AI platform, but, and this is the critical part, it's specifically for secure AI model distribution.
Secure distribution. So for the defense sector, that means it can run in, what, like classified environments?
Exactly. Highly sensitive air-gapped environments. So they're not just buying revenue here. They're buying technology that can handle classified data where, commercial platforms just can't go.
I see they're using the term agentic AI a lot with this. Can you break that down? That seems to be a new buzzword everywhere.
It is, yeah. Think of it like this. Regular AI responds to a prompt. Agentic AI can take a complex goal and work towards it autonomously, making its own decisions along the way.
So for defense, it could analyze intel feeds and suggest strategies on its own.
Precisely. Without needing a human to guide every single step. It makes the acquisition foundational, not just a small add-on.
And the financial impact they're expecting.
It's huge. The deal is expected to boost their annual recurring revenue by 6 times.
6 times?
6 times. So you can see why institutional investors are now so focused on how well they integrate this thing.
Okay, so the strategy is set. Let's look ahead. What are the hard dates, the catalysts coming up in the next 3 months that could really move the needle here?
Right. Looking at the calendar, a few things stand out. First up, December 1st, 2025. We have a possible ETF rebalancing event.
Ah, index inclusion. That can be a huge driver.
It can be. If BigBear.ai gets added to a new AI or defense tech index, it forces all those passive funds to buy the stock. It's almost like a forced demand spike.
A guaranteed passive flow. What's next?
Well, after that, you'd look to around January 15th, 2026. That's when we might see announcements of institutional buys following the rebalancing. It's the confirmation that the big money is moving in.
And then the big one, I assume, is earnings.
Yep. February 12th, 2026. Preliminary Q4 results. Everyone is going to be watching that for improved year-over-year numbers and, critically, any data on how that Ask Sage integration is going.
Okay, those are the dates. What about rumors? The defense world is always full of whispers.
The speculation machine is definitely running, especially after this acquisition. Most of the chatter is around new classified defense contracts.
Using the new Ask Sage tech.
Exactly. If one of those lands, it would be a massive, high-margin win that would instantly validate the whole strategy.
And what about partnerships? I saw some chatter about that.
Correct. People are watching for strategic partnerships with the major cloud providers. Teaming up with one of the hyperscalers could rapidly scale their distribution across a ton of different government agencies.
So a messy present, but a potentially very clear future. How does this all look on the technical side? The stock has had a great run.
It's been an exceptional run. The stock is technically in a confirmed bullish trend. It's up 76% year-to-date in 2025.
76%, so it's crushing the broader tech sector.
By a huge margin. It shows momentum. Investors are already buying into this long-term story, and they're willing to look past that Q3 revenue dip.
So where are we right now in terms of price levels? Is there more room to run?
We're at a really interesting spot, a critical inflection point, really. The price is right up against resistance, around that $6 to $6.20 range.
Okay.
If it can break out above that, especially on news of a contract or ETF inclusion, the next stop could easily be the $7 to $8 range.
And on the downside?
Major support is holding firm right around $5.
We have to talk about the volatility, though. I saw the beta is 3.19. That's high.
It's extremely high, and this is not an investment for the faint of heart.
So a beta of 3.19 means for every 1% the S&P moves, this stock theoretically moves over 3%.
That's right. It's a high-octane growth stock that's really built for momentum investors. The volatility makes sense when you think about the business. You know, lumpy contracts and a massive all-or-nothing transformation.
And I'm guessing the analyst sentiment is pretty positive to match that technical strength.
It is. The consensus is a strong buy. We're seeing price targets around $5.83. That's probably before fully pricing in what Ask Sage could do. And more importantly, institutional ownership is trending up. The big funds are buying.
Okay, so it's a very bullish picture, but it all hinges on future execution. We have to cover the risks. What are the big red flags here?
The risks are pretty classic for this type of company. First, that Q3 revenue decline. It's a real concern, and they need to explain it or reverse it in Q4.
And the second big risk?
Customer concentration. Being so tied to federal contracts means your fate is tied to the federal budget cycle.
So if Congress decides to delay a spending bill,
You get a massive amplified price swing because of that high beta. The bad news hits extra hard. And of course, the ongoing net losses. GAAP profitability isn't a guarantee yet.
they have the cash to survive, but they still have to prove they can turn a profit.
It's a classic trade-off. High risk, but the potential reward is genuine dominance in a very lucrative sector.
So let's wrap this up. What's the final take?
To summarize, you have strong government AI leadership, you have powerful year-to-date price action, and a huge catalyst in the Ask Sage acquisition. The general outlook gives it about an 8.5 out of 10 bullish rating, both for short-term traders and for long-term investors.
An 8.5 out of 10, that's pretty strong.
It is. The key for anyone watching this company isn't just the headline revenue number. It's about monitoring how quickly they can turn that massive $456 million cash pile and the Ask Sage tech into confirmed high-margin recurring revenue that finally plugs the hole from those net losses. That integration efficiency is everything, and we'll get our first real look at it with the Q4 result in February.